Nearly 4 months after the start of the Iran war, the U.S. economy remains remarkably resilient. While the conflict initially triggered a severe disruption to global energy markets and a sharp rise in oil prices, recent diplomatic progress between Washington and Tehran has eased concerns about a prolonged supply shock. Even before the signing of a preliminary peace agreement, most economic indicators suggested that the U.S. economy was weathering the conflict far better than many economists had feared. The conflict has reignited inflationary pressures and fueled widespread concerns about a potential economic slowdown. Yet, most of the key indicators released since the conflict began suggest that economic activity remains solid. While inflation has clearly accelerated and consumer confidence has deteriorated, the labor market remains relatively stable, business activity continues to expand, and household spending has so far resisted the loss of purchasing power caused by higher energy costs. The contrast between gloomy sentiment surveys and resilient hard economic data has become one of the defining features of the U.S. economy in recent months. The oil shock has not derailed economic activity. Historically, major oil price shocks have often preceded periods of economic weakness in the United States, US. For several months, the Iran war appeared to be following that script, with oil prices surging as the closure of the Strait of Hormuz disrupted nearly a fifth of global energy supplies. However, recent developments have significantly improved the outlook. The United States and Iran have signed a memorandum of understanding aimed at ending the conflict, while shipping traffic has gradually resumed through the Strait of Hormuz after Washington lifted its naval blockade. As a result, West Texas Intermediate WTI crude has fallen sharply from its war highs and is now trading near $69 per barrel, close to the pre-conflict levels and reducing the inflationary pressure that had built up during the conflict.